This is the lesson on 10.2 for journalizing cash receipts using the Cash Receipts Journal. What we're talking about in this section is we're processing sales transactions, and the different types of sales transactions that we're going to talk about are cash sales, which are pretty easy, credit card sales, using a traditional cash register, that's one like I think the drive-in has, and then using a point of sale terminal. All a cash sale is a sale in which cash is received for the total amount of the sale. So that's just, we're going to sell a shirt, they're going to pay us cash. It's really super simple. A credit card sale is just a sale in which a credit card is used instead of cash, and the person using the card agrees to pay whoever the bank is that issued the credit card. They're just agreeing that they're going to pay that. Traditional cash register, like I told you, is something like what the drive-in has. And at the end of the day, the cash register prints a summary of all the sales that they had, whether they were credit card or cash or whatever. And this is a great way, a great thing to use for journalizing your transactions, but it's bad in the sense that it's unable to provide the business with who or what was sold and how much it was sold for. So in your book, and also right here, are examples of processing sales transactions. The first one is UPC, or the Universal Product Code. You've seen those all the time. The other is just a normal cash register receipt. This would be one that is just very simple, just keeps track of what cash was brought in. And then the third one is a point of sale terminal, or a POS terminal report. Those are like what you see at Right Way or at Walmart or places like that. We're going to talk more about them in just a second. The point of sale terminals are computers that are used to collect and store all the information in a sales transaction. But before any of that can happen, somebody has to enter the number, the description, the price, and the quantity on hand, and then that gets stored in the POS, or point of sale terminal. Then the clerk uses a scanning device and scans that UPC, or Universal Product Code label. And then after she scans everything, it's like walking through at Walmart. They scan all your stuff, and then she enters how you're going to pay it. Are you going to pay it on cash or on account? So same two ways we've always talked about, either cash or on account to pay. Then at the end of a certain time period, whatever they choose, they're going to print out a report from that point of sale terminal, and it's going to summarize all the cash and credit card sales for that POS. Now, as you go forward, it's important to know that Hobby Shack is going to use this as their source document. From that point of sale terminal, there's three information reports that they can print off. They can report off a report of sales by clerk, which you might want to do that if you work somewhere in the buckle or somewhere that worked on commission. And all that does is shows how much that certain clerk sold. So if you were trying to track a person's sales, you could do that. The next one is a report of sales by time of day. So they might be wanting to track how busy a certain time of day is. And the third is keeps track of the quantity they have on hand. So if Right Way has 100 cans of cream of mushroom soup and they sell 40 in a day, it tells them at the end of the day that they still have 60. Here's what those reports could possibly look like. The first is the terminal summary, and you'll notice, and you can also look in your book on this, but here's all the Visa transactions, here's all the MasterCard transactions, here's all the cash transactions, and then it has a total for all of them. And then here is a batch report summary. So this is everything that they're going to bill Visa for, everything that they're going to bill MasterCard for. When they actually go to process the credit cards, the sales information is stored on the point of sale terminal, and then the terminal prints that report. And the report is called a batch report, and that report just lists the credit card and sales produced by that terminal. Then they have what's called batching out, and this is where they're preparing a report of all the credit card sales, and then they're going to send that out into the world. So the point of sale terminal transmits the batch report summary to the bank, and then that bank combines all its batch reports from all of its customers and submits that to the Federal Reserve Bank. Then once that happens, the Federal Reserve sends the funds out among the banks that those cards belong to. And then those funds are transferred back to the business. And that whole process takes 2 or 3 days. And so when you think about how many things happen along that line, it's really pretty fast. But keep in mind that Hobby Shack and almost all businesses are going to record those transactions on the day that they occur. So it doesn't matter when they get the money back from Visa or MasterCard after it's been through that whole process of the Federal Reserve. What matters is what day it was purchased on. And that's been the same throughout all the stuff that we've learned. So that leads us to the cash receipts journal. We have a special journal. We had cash payments in the section before this when we were purchasing on account. So now we have our cash receipts, and those are only for receipts. So if it says received cash, you know it's going to go in this cash receipts journal, and here's an example of one. The cash receipts journal has special columns, so if you look at it here, it's got the general debit and credit, then it has accounts receivable credit, sales tax payable credit, then it's got a sales discount debit and a cash debit. So remember that it's a cash receipts journal, so you're always going to have something in cash debit because you're always going to be debiting cash when you receive it. And then our new column here for our discount. And the sales discount is just a cash discount taken by the customer. So in section 10.1, right before this, we had a purchases discount where we figured, if you remember, 210 net 30, so we figured 2% of the sales we took off if we paid it within 10 days. Well, this is the exact same thing, only the customer is doing it to us. So now they're paying in 10 days, so we're going to give them a 2% discount. So this is going to reduce the amount that we receive on their accounts receivable. And then we have the general columns that we use for receipts that don't occur very often and that are not in one of those special columns. So there it is again, that cash receipts journal. You'll get plenty of use with that later. Okay, now we have, what are we going to do with our cash and credit card sales? We're going to combine them and record them as a single cash transaction. So we're going to consider those credit card sales as a cash transaction. So Hobby Shack at the end of the week batches out, which we talked about just a minute, and prints the terminals, or just a minute ago, and then they print the terminal summary. So the point of sale assigns the summary a sequential number. So just like our checks, our receipts, everything, we keep them in sequential order. Then we can tell if something's missing. And this is going to be used as the source document for cash and credit card sales transactions. So that's our objective evidence for their point of sale terminal. They total all of their sales at the end of the month. So that's when they're looking at sales. Even though they're running some of those reports every day, they're looking at sales at the end of the month. Management will determine, depending on the business and how much business they have, how often they're going to batch out, deposit cash, and record sales in the sales journal. And I know that Pit Stop uses a point of sale terminal, and they batch out every day at the end of the day, and that's what most businesses do. They do it at the end of business on that day, because if you have an error, it's harder to find the longer you wait. The accounts that you use are cash debit for total sales and sales tax. So the money that you bring in, you're going to debit it to cash. You're going to put it in that far right column. You're going to credit the sales account for the total part of all the goods sold. And then you're going to credit sales tax payable because you owe that to the government. So that is a credit to you until you pay. It's a liability until you pay it off. So here is an example of a cash and credit card sales. On November 4th, recorded cash and credit card sales for $5,460 plus sales tax of $327.60 for a total of $5,787.60. Terminal summary 34. Okay, so the first thing you're going to do is write the date in your cash receipts journal. And as soon as it said received cash, you knew it went in your cash receipts journal. You're going to place a check mark in the account title column, because in this instance you don't need an account title because everything you need is in a special column. You write the terminal summary document number, so that's going to be TS and then 34 in this case. Place a check mark in the post reference column. Write the sales amount, so you're going to credit sales, and that's going to be for 5,460. Then you're going to write the sales tax amount, which is going to go in sales tax payable, and then you're going to write the cash that you get. And then always double check that your debits equal your credits. And notice, don't get confused. Notice that before, when we did it, we're used to our credits kind of being on the right-hand side. Well, you'll notice once we get through our general columns of our debit and credit in our cash receipts journal, it has all the things we're going to credit, and then it has the debits on the right-hand side. So don't get confused with that. Okay, what if we receive cash on account? So they owe us, they come in and they pay on their account. We prepare a receipt. That's our objective evidence that they paid. All of our receipts are pre-numbered. This is the same thing we did when we were doing it in the first part of the book. And then this transaction is going to decrease the future payments that they owe to us, so we won't have to collect as much. So we're increasing cash, which is a debit, and we're decreasing accounts receivables, which is a credit. So here's an example of a cash received on account. On November 6th, we received cash on account from Country Crafters for $2,162.40, covering S69, receipt number 90. So we write the date, which is November 6th, the customer's name, Country Crafters, and in this instance, we can't put a check mark. We have to have the name because we have to know that that's whose account we're going to credit for having paid us. The receipt number. Then you're going to write in the credit amount. What did they pay us? So that's our accounts receivable credit for $2,162.40. And then this is a fairly easy transaction. Then we're going to credit or debit cash for the same amount. So they paid us the same amount. We put it on their account. We credit our cash or debit our cash. Okay, so now we're going to calculate cash receipts on account with a sales discount. So like I said in the last chapter, we did that 210 net 30 when we were buying. Now we're selling, and we gave our customer that same choice. So that's a cash deduction. Or discount. It's just a deduction that we are allowing on an invoice to encourage them to pay us sooner. The sales discount is a cash discount on sales, so the customer is going to pay less than the invoice that we previously recorded. So this will make more sense to you when we do this. So we're journalizing our cash receipts on account with sales. November 7th, received cash on account from Cumberland Center, $1,176, covering sales invoice number 74 for $1,200, less a 2% discount of $24, receipt number 91. We wrote the date, we wrote the customer's name, we wrote the receipt number, we wrote the original amount because we want to make sure we credit them for the whole amount of $1,200. But then we're giving them a 2% discount, which is $24. So that's our sales discount. And then we're going to debit our cash of $1,176. So the $1,176 plus a 24 discount are our debits. That equals our $1,200 credit. And I'm running out of time, so I'm going fast here. Cash receipts on account with sales discount. The sales discount is the account used to record a sales transaction. It's a contra account to sales because it decreases sales. We could just debit sales, but this provides more information for management to determine whether or not their sales discount is effective and encouraging early payment. If a customer doesn't pay the amount within the sales discount period, the full invoice is due. So here is an example, and I think we may run out of time, but you write in the date, you write the customer's name, you write the receipt number, you write the original invoice amount in your accounts receivable credit because you want to credit them for everything. You write the amount of the sales discount in the discount, and you debit cash. Okay, this is going to shut off, so we are done.